These are the big banks, and if they fail to deliver, creating a massive spike in the price of gold, it would reverberate through all of their dealing. Look, if a major player fails to deliver, what does that say for the rest of their dealings? And it would create reverberations very quickly. In terms of the price of gold and silver, it would spike in a very parabolic manner because the LBMA is not an exchange. They don't have those types of rules that we see on COMEX. But if you see the COMEX stop allowing delivery because of something like that, I mean, everything goes haywire in a matter of moments.
In today's episode, Andy Schectman dives into the art of stacking gold and silver the right way. He emphasizes that successful stacking isn't just about accumulating metals. It's about a strategic approach that ensures long-term security and financial resilience. Schectman stresses the importance of prioritizing physical metals over paper-based assets, noting that true wealth lies in tangible ownership. He also highlights the value of balancing gold for stability and silver for its growth potential, helping stackers build a well-rounded portfolio to withstand economic challenges. Schectman shares his bullish outlook on precious metals, citing critical macroeconomic factors like rising inflation, unsustainable government debt, and the global trend of de-dollarization. These, he explains, are driving demand for gold and silver as essential hedges against economic uncertainty. He is particularly optimistic about silver, praising its unique dual role as a monetary asset and a key component in green technologies like solar panels and electric vehicles. With industrial demand poised to surge, Schectman believes silver's potential is unmatched. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and check the pinned comment. We're offering a big discount in NordVPN, which is an essential tool if you want to browse the internet in a secure and private way. For just a few dollars a month, make sure your privacy is never compromised.
Look, I mean, it could be much more dramatic than that. These banks, the Bullion banks, are the biggest banks in the world. They're the JP Morgans, they're the Citibanks, they're the Deutsche Banks, the Standard Charter, HSBC. These are the big banks. And if they fail to deliver, creating a massive spike in the price of gold, it would reverberate through all of their dealings. I don't want to say this is the reason, but, so many people are looking at Bank of America. Ted Butler said they're the ones that are short the most, naked short 40 million ounces in gold and 1 billion plus ounces in silver. Now, God rest his soul, he's been dead for a little while. I haven't seen much in the way of update in terms of what they've done with those positions. But look, if a major player fails to deliver, what does that say for the rest of their dealings? And it would create reverberations very quickly. In terms of the price of gold and silver, it would spike in a very parabolic manner. So I don't know. I mean, these are uncharted waters. And this is what happens when you mess around with Mother Nature and you suppress interest rates and you suppress prices that are diametrically opposed with half of the world's GDP, over half of the world's population, countries that are wise to the game and realize that a new system will be one that will be pegged to something like commodities. And this is the only reason they're not bitching, because they're the ones that are benefiting from our stupidity. What it will really do is put the West behind the 8 ball. And I think by that time, maybe, long before that happens, the COMEX would enact force majeure. Now, that it's not going to happen that way on the LBMA, because the LBMA is not an exchange. They don't have those types of rules that we see on COMEX. But if you see the COMEX stop allowing delivery because of something like that, I mean, everything goes haywire in a matter of moments. So I don't know how to answer that question other than to say it's kind of on a razor's edge. But I think the point of metal reacts this way, the markets are reacting this way to just a simple suggestion of a change in policy or any type of geopolitical event. You tell me, how fast would it spiral in the world we live in now? I think it would happen very quickly, and it would be very dramatic. Well, look, the October tally of gold purchases by the central banks doubled that of the 12-month average. over the last year. And the central banks are buying hand over fist again. China is doubling down their purchases. They never stopped. And that was evidenced by the import export numbers out of Switzerland and the United Kingdom. They were buying stuff, as we've talked about, through the People's Liberation Army, which is not reported to the IMF as it would be if it was done by the PBOC. They're buying through proxy banks, commercial banks in China that are not directly reporting that to the IMF as they work on behalf behind the scenes of the PBOC. We've talked a lot about how they have been buying doré and concentrate from South America, Latin America. And there was just a report that came out that said 78% right now, 78% of their raw silver is coming from South America at the current time in the form of concentrate. And so, the amount of purchasing that we are seeing, it's probably why we've seen the bullion banks start to cover. I think they realize that the purchasing is not ending. When we saw Trump win the election, there was a euphoria, and rightfully so, as we've talked about, for many reasons. This gave the bullion banks the ability to push the ball down the hill to get it rolling, and the managed money, who was sitting on a lot of profits, capitalized by cashing out, which allowed the bullion banks to push the price further. It kept falling and falling and falling. Gold fell by $200, and a lot of those short contracts were covered. But this was an opportune moment, really, for the central banks, who have been buying it hand over fist, and it hasn't stopped. And really, the big buyers are the People's Bank of China, the Saudi Central Bank, along with Turkey, along with Kazakhstan, along with India. These countries and Poland are buying hand over fist to the point where we now have, it's up many-fold from what it is on a moving average. And you mentioned something that we've talked about a lot as well, and that is the repatriation of gold. We've talked about that for a long time, how the West has, I think, it lost its, you could say, its trust. You could say it's the West's decline in financial dominance. It's the fact that these countries don't want to keep their gold or silver any longer at the Bank of England or at the New York Fed. And as we've said a lot, the Bank of England gives direct access with safety, supposedly, to the London Metals Exchange, or the LBMA, and the Federal Reserve Bank in New York to the COMEX. We are now seeing up to 78% of all of the world's gold, or at least the central bank gold held, is now in the countries that possess it. So in other words, another way of saying that is that 22%, that's it, 22% of central bank gold is held in these locations to give direct access to the COMEX and the LBMA. So, 1 out of every 4 ounces, the rest has been repatriated. This is a big deal. Mm-hmm. Maybe 1 out of 5 ounces, actually. It's a very big deal. In 1972, it was half of the gold. 50% of it was held at the Bank of England and the New York Fed. It's now down to 22%. It's a big deal. And it really, I think, goes to show that these countries are no longer trusting that we will even repatriate or return their gold, rather, just like what happened to Venezuela. It's a big deal. And I think it will continue to happen. Not only are these institutions draining the world's supply, but they're no longer leaving it in custody with the West. Big deal.
In today's news recap section of the episode, gold price faces strong headwinds ahead of Federal Reserve meeting. After testing resistance at $2,700 at the start of the week, gold is once again on the back foot as stubborn inflation takes its toll on expectations surrounding the Federal Reserve's easing cycle. The precious metal received a much-needed boost earlier this week as investors reacted to news that China's central bank resumed buying gold. After a 6 6-month break, data from the People's Bank of China showed it purchased 5 tons of gold in November. According to many analysts, the data underscores China's significant role in the gold market and highlights healthy central bank demand heading into 2018-2025. However, the precious metal continues to face near-term volatility as attention now shifts to the Federal Reserve's monetary policy meeting next week. According to the CME FedWatch tool, markets have fully priced in a 25 basis point rate cut following the Fed's final meeting of 2024. There is growing uncertainty regarding the duration of the current easing cycle in the new year. The gold market began selling off this week after the U.S. Labor Department reported that its headline producer price index rose 0.4% in November, following October's unrevised 0.3% reading. Over the last 12 months, headline wholesale inflation increased by 3.0%, well above the consensus of 2.5%, and October's upwardly revised 2.6% reading. The rise in wholesale inflation suggests that the threat to consumer prices remains elevated, which some economists say will discourage the U.S. central bank from raising interest rates. In its outlook earlier this week, analysts at Wells Fargo said they expect only one rate cut next year. Similarly, Bank of America recently forecasted just 2 rate cuts in 2025. Naeem Aslam, Chief Investment Officer at Zay Capital Markets, said gold. Investors should prepare for potential weakness next week as the Federal Reserve pares back rate cut expectations. Another analyst, Lukman Otanuga, is more neutral on gold, noting that the precious metal is caught in a tug of war. He added that while a hawkish Fed is negative for gold, the yellow metal still retains plenty of bullish momentum. Now we'll show you the best clips of the latest interview. But first, hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you keep your data private, especially if you're browsing investing-related material. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
That a bunch of people trying to buy physical here in the States have the ability to overwhelm the silver market, like silver squeeze we saw in 2021. But I'll tell you one thing, these banks who are stupid enough to have millions, if not billions of ounces short between London and New York, naked, 90+% of it, figuring that no one's ever going to stand for delivery, they've been lulled like the frog in a pot of lukewarm water into the belief that that won't happen. And it's happening. And it's happening again. Just the other day, we see during November, only 5.5 million ounces of silver were delivered off the exchange. They don't take too much, but little chunks by little chunks by little chunks. And all of a sudden you wake up and, whoa, where did it all go? And it's not coming back. And that was after the price got the crap smacked out of it in November. Of course, that's when they stand for delivery. They're smart, and they're smarter than the folks in the West who are dumb enough to try and perpetuate this ongoing fraud. And they're wise to it, Dunnigan. And this is the type of event where you see the premiums on exchange for physical go through the roof, and tightness in the good delivery bars, both gold and silver. That you see massive delivery requests. What happens and how does it unfold? This is the beginning of it. So look, I'm not trying to sensationalize it and say it's gonna happen, but this is certainly the first step of something like that coming to fruition. 400-ounce bar, they melt it down, make it into kilo bars as fast as they can. And they don't want to, who knows what kind of fraud that this really is, and they try and say, well, we need those bars back, or however they want to do it. I have no idea, but they're very fast at converting them directly into kilo bars. They're gone, and they won't come back. Why would they? And this is the part that I think people neglect to understand, that we're being beat at our own game. We're being outfoxed, and they understand that. Sure, people initially would think, well, they have enough money, just why don't they empty the exchanges? Because the minute you do something like that, you've cut off your nose to spite your face. Instead, I remember the first time you and I had this discussion, and it was the others that were standing for delivery, the sovereign wealth funds. That was in 2020. So since 2020, they have been very methodically draining the world's exchanges. And who knows how much they've built up. I mean, India has bought between 8 and 900 million ounces over the last 4 years of silver from what they've declared. Well, that's more than the LBMA has in total in its inventory, of which 500 million of the 800 million ounces belong to the ETFs. They have 300 million ounces. That's it. And India has imported at least 3 times that over the last 4 years, slowly, quietly. And China's doing it. And now Russia is adding it to its actual state strategic stockpile. You can see things are accelerating a little bit, but they've done a masterful job at beating us at our own game. And I feel like I bang my head against the wall when I keep saying this, but this is exactly the kind of beginnings that you would see before a real problem arises. And look, how many times have people said this is the time the problem's going to happen? It probably won't. But if it does, this is how it starts. It starts when there's a failure to deliver, and then it's a daisy chain. And when you see the premiums on exchange for physical go through the roof, and then you see, massive short covering because the trade, and it's interesting, the premiums went up a day before this was announced. The traders kind of got wind of it a day before it became evident why. And it is because he is threatening to put tariffs on gold and silver coming into the country. Not sure what his reasoning is, but it's enough to make the traders start to freak out.
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.